Tonight we'll work one more of these ALM problems. Pretty straightforward problem. Most students do pretty well on this one. And then Thursday we'll spend some time prepping for the exam, doing some practice, working some problems from the last exam so you can get a sense of the exam. This is the last exam from last year. The problem, the exact same problem. So you'll notice it only has the triple B in the high yield, gives you the yields 5, 10, and 925. I try to use current yields for the exam. High yield is, their spreads are so narrow right now. I don't know how I'm gonna get the problem to work. I don't know what life insurance companies are doing right now other than just paying really, really low crediting rates. These numbers will be the same, the 20% and the 4%. The hundreds, watch out for the target RBC. Make sure you know where that number is. That's going to apply to these two numbers. So make sure you're aware of that one. So there are numbers that do change. So let's work through this. Don't waste this time. You got to practice for the exam. You might as well use this time now. I think some students really kill themselves by using class time to do stuff that's of no value to them on the exam. We got an exam next week, right on Tuesday, I think, right? It's like only a week away. So it's a very mathematical exam, very little essay. The essays are just short answer. So it should be pretty straightforward. So on this one, what I said, step one is do the capital requirements first. I think that makes the most sense, just so you have that out of the way. So you have a triple B bond and you have high yield, and you have C1 risk and you have C3 risk, and then you have the total. So the risk, C1 risk is 4%, but we're going to multiply it by 1.6, 5.2%, 0.04 times 1.6, so I'm a 6.4, wow, that's bad math, 6.4%. The problem probably will be 100,000, so that keeps the math really simple. Times 100,000, that's going to equal 6,400. The C3 risk is going to be the same for both bonds, so that one doesn't really matter. So the C3 risk is 1%, but we're also going to multiply that by 160%. So 0.016 times 100,000 equals 1,600. So 6,400 plus 1,600, I think, is 8,000. Y'all check my work, make sure I'm getting. Don't be the student that tells me on the way out of class, so that now I have a video with all wrong numbers. So that looks right to me. The high yield, we're going to apply 1.6 to the 20%. That should give us 32, but we'll see. 32%. It's going to give you $32,000. This one will be the same, so you don't have to do anything there. So you should get 33,600. There's step one. Step two is real simple. Just fill in income statement. Real simple. So you have the triple B and you have the high yield. So you have revenue. You have the net revenue. You have your crediting, your expenses. That's going to give you net income. And that should give you the ROE. So really, really straightforward. What's your revenue? Well, the bond is making 5.1% and 9.25. So you just multiply those. This bond will give you 5,100. This bond will give you 9,250. Y'all stop me if I do something doesn't work. So the net is we're gonna say, we're gonna make 5,100, but we're gonna pretend like we make a little less than that. We're gonna take a little bit of a haircut off of that. I don't know who came up with the term haircut. For triple B, it's only 10 basis points. 10 basis points times 100,000 is just $100. For the high yield, we're going to take 2% off, so that's 2,000. So we think the bond's going to make 5,100, but on average, we'll lose $100 because of defaults, net of recoveries. So we're really going to assume the bond's only going to make us 5,000. For the high yield, we think we make 9,250, but we're going to have a lot more defaults. So we're going to assume we only make 7,250 on that. So the nice thing about this net income is everything is subtracted. Revenue, you then subtract haircut, subtract credit, subtract expenses. So it's revenue minus everything else. The crediting is going to be this, the crediting expenses would be the same for both of them. The crediting rate is 325. So that's 3,250. The expenses is 1.1%. That's a pretty low load. So that's 1,100. All right, any questions on any of those numbers? See how pretty straightforward it is. You just follow the income statement. And there are no bogus numbers. It's not like I throw in something up here. So you might check off as you use each number because there's not a number up here you're not going to use. Okay, so that should help you. Then what is my net income? Oh my word. 5,000 minus, this looks like 650 to me, but I can't do that in my head. Someone check my math here. 5,000, that's 1,750, 750, 650. Maybe y'all do the math on me. Takers. This one here? Is that one's right? Okay, what'd you get here? 49. All right, I haven't done that one in my head. It's hard to do math when people are looking at you. So 7,250, 4. Yeah, 2,900 looks right. All right, and then your ROE, you just take the 650 and divide it by the 8,000 that we had up here. And here we take the 2,900, divide it by the 33,600. 8.125. It's 3. I agree those. What was our target? 8.5. I don't know if I can get that to work this next exam. It's going to be tough with high yield being so low. I might cheat and not use current rates. My guess is there's not many life insurance companies buying high yield right now because they're just not getting paid. They're probably buying a lot of triple B right now. And the competition, how do they get around this? Well, the competition is probably because spreads are so tight, they're probably paying much lower crediting rates. So it's not like, everybody's in a different boat. They're all facing the same things. So something along the lines of why high yield is the bond that meets the 8.5% ROE target. We cannot put more than maybe 10% on high yield. So we will be missing 8.5% target, something along those lines. And then don't miss this part of the question. Maybe I should make it a separate question. Right there. Fully discuss the options a life insurance company has if it cannot meet its ROE target. So you need to show your work and your recommendation. What's my recommendation? Well, we can put 10% in high yield. We can't do more. We're just going to have to miss the ROE target. So solutions. Here you just go across the income statement. Get higher yields. Each one of these has a caveat. What's the caveat here? Well, first of all, portfolio manager should already be doing that. It's not like you go, oh, you want me to work harder. Oh, I didn't know that. I was just finding really simple bonds, but I can work harder. But no, they should already be working harder, and they do. The second problem is when you ask for higher yields, you are also asking for what? Why didn't the bond manager buy a triple B with a higher yield? Because he just thought it was too risky of a bond. The credit rating's rated at triple B, but he thinks it's really double B, and so does the market. That's why it's got a higher yield. Those are the kind of things. So what's the next thing on? You could change the haircut. But here, you need to be honest, or you lose money, right? Your haircut needs to be 0.1%, then it needs to be 0.1%. If it's too high, yeah, bring it down. I think I showed you that 0.1% is a little bit high. History supports something more like 0.007. But so you need to be honest. What's the next one? The crediting rate. You could reduce crediting rate. Anybody remember what the issue there is? Huh? Yeah, it hurts your creditor position. See, I'm just going across the income statement. Next one, reduce expenses. But you should do that anyway, right? If you can operate more efficiently, operate more efficiently. You shouldn't be saying, hey, let's have more parties and waste money. No, let's actually be good stewards. I had a debate with a lawyer at UTSA. We were on a private jet. And he says, anytime I travel, I go first class and I stay in nice hotels because this is a burden to me. And I told him, yeah, there's military people on deployment that are paying for your first class airfare. It's not your money, it's their money. So when I travel for USA, it's like I was a cheapskate. It's like I'm not gonna spend someone else's money. But yeah, there's people like, hey man, anything I do for the company, it better be first class. And they don't think about they're spending other people's money. It just doesn't bother them at all. But anything you can do to be more efficient, more effective, yeah, definitely do it. What's the next one? You could reduce the ROE target. What's the problem that? Stock price falls. The required return. So the stock market's going to make you pay for that. You could reduce I forgot what I call it. The target RBC ratio. What's the problem there? You get downgraded. Right? Ratings, you say, wow, you don't have enough capital set aside. One other one, it's in the notes, but I didn't think I did in class. You could reduce C3 risk by making product more restrictive, but customers won't like that. That's one that's kind of there. So if you're not sure what this list is, it's in the class notes. I'm not sure which page it is for y'all, but you can just look up the term, what if you cannot meet your ROE target? Stretch for yield, reduce your RBC target, reduce your crediting rate, cut expenses, change the haircut, change your target ROE, and make C3 risk lower. So there's a list. I don't know if you can come up with a mnemonic for this list here. I think it's 7 things. 1, 2, 3, 4, 5, 6, 7 things. But I don't think you really need a mnemonic because it's the first 5 are just going across the income statement. And then the last 2, yeah, you have to kind of look for those somewhere else. But yeah, it's essentially that what's typed here is adequate. I don't need a lot. I don't need massive essays. So this is, if you're interviewing with an insurance company, if you understand this right here, you really understand the business. This is what it's all about. You've got to somehow get good at this. Right, so you've got a second problem there. We showed all our work. Do you show all your work? Because if a math error, I can't give you credit for a math error if you don't show me your work. Make sure you use every single number on this page. There's not a single number here you don't need. Make sure you have a recommendation. Don't forget that. That's this part right here. Here's your recommendation. And then don't forget this fully. Some of my students hate that word. This is not quite as extreme on this exam as it's been on previous exams, but fully discussed. So have all 7 of them. And I do mean include the caveat. That's what the fully discussed really means here is stretch for higher yields, but change the haircut, but reduce credit. But none of them are an easy solution. Not a single one of these is an easy solution. All of them have, kind of sounds like what Sewell said, there's no solutions, just trade-offs. So they all have difficult issues. Should be a straightforward question. I don't throw any curves here at all. So what we'll do Thursday, talk about the exam. And so what the exam will do, I'll just show you now. There will be some questions that say, show equation, don't solve, show equation, don't solve. So you'll have a couple of those. By show equation, don't solve, what I mean is use the D45, the L45, whatever. Don't go to the mortality table to get the numbers. That's what I'm trying to save you time on. Just say D45. So you might do D45 times, well, if it's $100,000 policy, do the 100,000. If the rate is 5%, then I'll put that 5% in there. So do put the face in, do put the interest rate in, but you do not need to go get the D45 from the table. All right. So what kind of problems will I do here? Probably level term, ordinary, whole life, maybe limit pay, whole life. Those are the type of problems I do. All right. We did several of those. We'll do some practice, some more of them on Thursday. Those can switch. So if on Thursday we do a level term, it might be a different type of product. Remember, if it's a 3-year level term, how many D's are you going to have in the numerator? You're going to have 3, right? How many L's will you have? You'll have 3. This is not the formula, but all right. So if it says 3-year level term, you'll have exactly 3 D's. And if I don't say anything in premium payments, you always assume the premium payments are the same number as the depth. Ordinary, you keep going until when? D99. And what do you divide by? You keep going until when? Someone say it loud. So an ordinary whole life, you start, if it's ordinary whole life at age 96, and you start with D96, D97, D98, D99, and your L's will be L96, L97, L98, and L99. That's what ordinary means. If I say limit, you see the word limit, I gotta tell you how many premium payments there are. So if it says ordinary, you know, don't come up to me and say, how many premium payments are there? I can look at you like I've never taken this course in my life. I know what you're talking about. All right. The word ordinary tells you that you have the exact same D's and L's in the equation. All right. 3-year level term, you have the same number of D's and L's, same numbers, same ages. Limit pay is the one exception where say it's limit pay for the first 2 years, then you're just going to have L45, L46. You won't have the others. Okay. Then you will calculate one that you will definitely calculate is the modified endowment. We did one of those, and the reconciliation, which is the biggest math crunch of the exam. That does take some time. You'll have plenty of time because these questions, I give you like 5 minutes on these questions. They usually take like a minute. They're pretty fast, so you'll have plenty of extra time. We'll work on these again. It's a massive one. Then you have the unusual problem. We'll work one of those. We'll work the one from last exam on Thursday. There you can get a lot of partial credit if you'll just put down what you know. Remember there, how do you figure out the N? The N is going to equal the age, the ending age minus the starting age if an L, and the ending age minus the starting age plus 1 if a D, right? If it's at the beginning of the year, you just subtract. So you say, hey, this pays people $100,000 at the beginning of age 97, and you start at age 30, your answer is between 97 minus 30. If this says this pays people who die at the end of the year, you'll take 97 minus 30 plus 1, that will be your end. So if you remember that, you'll get that problem down pretty well. Some students leave that problem blank, but you just did a bunch of the problem here. It says it pays a death benefit at age 97, and stick a D97 in your numerator. That's pretty straightforward. If it says there's a premium paid at age 30, put an L30 in the bottom, but put something down. You can get some credit. And then you will have the joint life. We might need to work 2 of those on Thursday just to give you some more practice. We might tonight, we'll see, get some extra time. And that one has the short essay. Essentially, the short essay says is for young people, you might as well just buy the 2-term policies. Why? Because the probability they both die is very, very low. You might as well just buy the 2-term policy. It's not going to cost you that much more, maybe pennies. When people are older, 60 or older, the probability that both die becomes higher. So the 2-term policies will be more expensive. So then it really depends on why they're buying the insurance. Does it matter if they both die? Does that cause some issues? So that's the essay there that's in the class notes. Then you have the ALM problem that we just worked with, the essay, recommendation, and the list of stuff. That is the entire exam. A lot of math. Very, very heavy math. Actuaries love that. But you got to know the math. Don't come in this exam having looked at it kind of high level and thinking, I got to, some students, I think, mess up my classes because they study for my exams as if it's just another one of the multiple choice exams. You're gonna sink. You can circle C if you want to, but it's not going to help you on this exam. Right? There'll be some C's in the text, but it's not going to help you. You got to know the answers. All right. So that is the exam. I'll put an exam guide out there, but that is the exam. All right. Any questions on any of this? Now, right now you're like, man, I don't know any of this. Why? Because we haven't looked at this, we had Thanksgiving, all that stuff. Did y'all have any arguments over Thanksgiving about healthcare? There were a couple of really, really amazing papers, a lot of really strong. Y'all saw the class average was like an A minus or B plus, really strong. Some of y'all just ran out of steam. 70%, 80% through, and then just like, I can't do this anymore. That's why I was saying write it as we go. But yeah, there were a couple of hundreds, and there was some strong papers. Um, I disagree with some of y'all, but it doesn't hurt you on points. Kind of interesting takes, but yeah, it's an interesting paper. All right, so there's your exam. You know exactly what's on the exam. So what's it? Every person in this class get on this final? Everybody should get a what? 100, right? There's absolutely no reason everyone in this class shouldn't get 100. How many hundreds do you think we'll have out of 40 students? I would love to have 100, 40 100s, but we'll see. Y'all think I want y'all to fail, but I actually want y'all to succeed, but by doing the stuff right, not by me just giving you 100. So you know exactly what's going to be on the exam. You've seen it. If you've been coming to class, we've been doing practice problems. It's going to come back to you as you get into it, because it really isn't as complicated as it seems while I'm showing you this. It really is very repetitive. This one can be a little shocking, but I've gotten kind of similar on that. I'm a little bit worried about this one. This one on the reconciliation, some students really crash and burn there, but I'll get you as much on that Thursday, so you have another problem. And y'all saw that one's pretty straightforward. All right.
What's the average typically on these exams?
That's usually B minus, yeah. Understand, but it's pretty barbelled. Yeah, there are students come in here just not prepared at all. Now, I have students that come in and say, I just had 2 finals a day. I'm so exhausted. They need to talk to me, and I'll find a place that you can make it up at a different time or something. So yeah, if that's your argument, then talk to me. We'll find some way, find another time. All right. So the class notes, what haven't we covered? We haven't covered accounting for life insurance companies. I use MetLife. You do need to know if you go into an interview for life insurance companies and for property and casualty companies that they have at least 2 sets of books. Probably more, because accounting, the taxes for these companies is really tough. So they even have a tax book. But they have statutory, which you call stat, and they have GAAP, which is what you know. You taught GAAP. They are materially different. They can be pretty radically different. Statutory is what the states required, and they have their own set of rules. There was some work several years ago to try to coordinate all the states, and that was one of the worst projects in the history of projects. I don't know if you ever seen someone try to write a book where they assign a chapter to people all over the country and say, write a chapter about this. So it was just absolutely horrible. They couldn't agree on anything. So I don't know where that project is. What they're trying to do is better reconcile stat between the states and the GAAP. And they end up just making it worse. So it was just a mess. But statutory has its own rules. The key with statutory is its focus on the customers, focus on solvency. So it's very, very, very conservative. So if you're an actuary and you're setting up reserves, for statutory, your reserves are going to be much, much higher. For GAAP, they're going to be lower. So for GAAP, you set up stuff to be realistic. Now, GAAP is supposed to be conservative as well, but statutory is extremely conservative. So a company, their statutory net worth is going to be much lower than the GAAP net worth, just because of that conservativeness. They call it the annual blank. When I started at USAA, my first year I was in the management side, management accounting side, but I moved over to the accounting side right when they're doing the annual reporting. And back then, we were actually typing on typewriters, which you don't even know what that is. But they had just gotten PCs. We're starting to do things electronically. It's just amazing. If I could show you MetLife's annual statement, statutory blank, it's hard to even imagine how they did this in the 50s and 60s. You've seen the big bays of typists, right? Just in some of the old movies. So I can't imagine. The statutory blank lists every single security that the company owns. Not only that, what its CUSIP is, what its yield is, what its dollar amount is. For State Farm, that goes on for several hundred pages, because they own about 100,000 securities. I don't know who typed all that. When I started at USA, when I was starting this department, they just gotten the computer to bring all the stuff from the investment accounting over into the statutory. And the first time they tried it, something that used to take hours and hours and hours took them a few minutes. So yeah, it's amazing now. It's very automated now. It goes to the regulators. GAAP, you have to file if you're a public firm. So State Farm, USAA, some of these mutual insurance companies don't have to do GAAP. USAA was just starting to do GAAP when I started there, and then we got a new CEO, and he just liked GAAP better than stat, so we changed the focus. But those are required by the FASB, by the accountants. They can be very different. I love statutory better than GAAP because it just has. If I showed you Met's financials, there's just so much data. It's really, really, really pretty amazing. And now they do have the ability to pull this off electronically. So if you're an actuary or finance person in an insurance company, you really need to go ask not about the TV show, but SNL. You should ask your firm if they have SNL. It's owned by Standard & Poor's now. USA has it, but no one knows they have it. So you have to go find that person who knows it. We had an intern once, and I put him on a project. I wanted him to see, how does USA differ from all the other companies out there? How much high yield bonds do we have? How many BBB bonds do we have? How much mortgage-backed securities do we have? How many bonds do we have that are financials? And he was able to pull all that data. He was a really good intern. He was able to figure all that out and bring in data. We could look at the yields on our bonds, how good they were doing. We could even break down credit ratings like AA plus, AA minus, all the way down. Pretty amazing. How much do they have in stocks? How much do they have in real estate? So this is all there so that for State Farm, which is about 500, 600, 700 pages of data, this SNL database allows you to bring that in really fast. So let's say you're a newbie at USAA or MetLife, and someone has a question, is like, man, I wonder what State Farm does. You say, well, do we have the SNL database? Oh, I don't know. Oh, I called. We do have it. Y'all want me to pull that data? That's what you want to be in your first job, right? You want to be the saver. Come in and you have the answers to the question, not arrogantly like you know something they don't. You can say, man, I heard about this. I think it'd be pretty good. So I don't know how expensive it is. So you may find that your firm doesn't have it. And you might ask, hey, is there a possibility we get this data? Now, your firm might have Bloomberg. Bloomberg does not have all of this data. It has some of it, but it doesn't have all of it. So we're missing a lot of it. It's pretty amazing. One of my best presentations at USA was early in my career. I brought this data in. I built the efficient frontier for all of our competitors, where we were versus where they were. And I did it on an after-tax basis because USA has a massive tax advantage over its competitors. And I could show that our expected return was higher than State Farm's with far less risk. And they just ate that up. It's like, man, we should take advantage of our tax advantage that we have. So be aware of this. I don't know what the SNL stands for. It's not Saturday Night Live, but it stands for something. You might be able to find it. But every single company files with the states, and then the states send that data to SNL, and SNL sells it. And a really easy way to use it, so it's very easy to bring the data in. And it's pretty amazing. I'm not going to go through the details. You can read the class notes. The life insurance side, their statutory is called the Blue Book because it's blue. On the P&C side, it's called a Yellow Book. Y'all remember early in the class, we talked about variable products, variable annuities, variable life, variable universal life. Those are shown in the Green Book. So they have their different books. At USA, I was constantly looking for the green and blue book and yellow books. And Tim was my contact. Tim had all of them back to the 40s and 50s. It was pretty amazing what he had. He wouldn't let me borrow them without, promising my firstborn or something. But it was like, Tim, can I borrow the 1962? He guarded those. He was really quite the historian. I've kept all of those. So I can't go into this. There are some unique things like DPAC for life insurance companies, especially. It applies to P&C, but that's something that only applies to insurance. And who runs that? you might think, well, that's something the investment people will do or the accountants would do, but this is actually something the actuaries do. There's quite a bit of accounting that the actuaries do because the math is just way too complicated. And Deepak, I understood it for 15 minutes one day as the actuary came in and explained it to me. And then 15 minutes after he left, I could remember all he said because it was so complicated. If you took an accounting class where they did the LIFO unlocking, you remember that? Pretty complex. This is like 10 times more complicated. It's very, very intensely mathematical. So there are some things in the insurance business that you just don't see anywhere else. I could even show you, if I showed you Allstate. Oh, I can't spell Yahoo. But you can actually even see it in their financials, and it's not an inconsequential number. Get where they put it, but it's in here. It is in here. They use, oh, here it is right here. Look at that. There it is. Policy acquisition expense. Their net income is $8 billion. Their policy acquisition was $8 billion. They add that back, which means they would have made no money without that adjustment. So is that a material adjustment? Yeah, pretty material adjustment. I want to explain what it is. I remember the first time we told our CEO, because he had no insurance background, what it was. He's like, you got to be kidding me. But some unique things. You can read through the rest of them. So yeah, here's the SNL link. I can't show you risk-based capital if I showed you Allstate's or MetLife's. It is in their financial statements and it's on one page. It's called the 5-year historical data, or 2 pages. I love those pages. They have 5 years of data. That's the only place the risk-based capital is, but you can get that data. If you take my property and casualty class, I actually put risk-based capital on the exam, but you don't do it in this class. Insurance companies are all also rated, but Moody's and S&P in particular, AM Best as well. I don't know if any of y'all thought about becoming a rating analyst. It's a great career on your resume. It's a horrible career for your stress and time. But you want to pay your dues and be set for the rest of your life to become a rating agency analyst, S&P and Moody's. It's very, very long hours. It's pretty amazing job. You go to the websites if you're an investment person, you really like the fixed income side, but you want to get a good start, go to the websites, look for jobs. They probably have some entry-level jobs. I've had a couple of students work there. But it's high stress. A good friend of mine, she and I used to work together. She and her husband moved to New York, so she took a job with S&P. She knew insurance companies very well, so she was an insurance analyst. First day she walks in, the guy before her had left. There's a 15-foot high stack of paper. She didn't know what to do with that. She says, what I do? And they say, well, here's your company. Start analyzing them. This is what I do. They said, no, you know what you're doing. Just do it. She analyzed them. She's ready to write her first report. She says, go, who reviews this? No one reviews it. Just publish it. So she says, okay, great. No training, no explanation. They just said, here's your company, you figure it out. That's a stressful job. She's very, very smart, so she figured it out. But a very stressful job. I visited her at her company. I was like, Lisa, I could never do this. She says, oh no, you figure it out as you go. Obviously, you find someone in the company that will maybe give you some insight. But yeah, you just start writing. So they probably have some entry-level jobs that aren't quite that stressful. That would probably be impossible for someone right out of college, I would think. But they do exactly what you would do with other companies, but with some extra analysis. They do typical fundamental analysis. They're looking at quantitative things, qualitative things. They view the overall industry. Their biggest focus is on your net worth. Do you have enough net worth for your risk? So it's just critical for these companies. That's what risk-based capital is all about. It was pretty cool one day. I was at my desk minding my own business, and Moody's called me. And they knew we had the SNL database, and they say, we're developing a new risk-based capital requirement. but we don't have SNL. Would you be willing to test our new model on the industry? And it's like, okay, I get to see your model for everybody else. Yeah, I'll do that for free. I told my boss, I'm working for Moody's the next 3 days. Because I got to see their entire model, see where we're strong and weak, and send it to them. So I had the inside scoop. I couldn't publish it or anything, but I could certainly tell my boss what they were doing. So you mean, see how SNL is a great help. They look at liquidity because there are runs on life insurance companies. We haven't seen one in a while, but there have been some articles here recently, especially by Japanese life insurance companies. Japanese life insurance companies like to buy US assets, which means if the yen strengthens, they're in a lot of trouble. And so that's a huge risk. So they look at that. What's the risk? We saw a run on the bank with Silicon Valley Bank. It has happened with life insurance companies. It's much rarer than with banks, but it can happen. But they look at if all of your customers want their money back, could you actually get the cash fast enough? They look at asset liability management, just like we talked about. What happens if interest rates rise, interest rates fall? They look at that very carefully. They do hire actuaries at rating agencies. So if you're an actuary, you might see after working as an actuary for 4 or 5 years, you might see your income triple in 1 year if you go to S&P or Moody's, if you don't mind the long hours. They do pay very well for actuaries. So
Has Moody's bounced back from the changes after their IPO? Where they just had crazy lower ratings?
I mean, they've been public for quite something. Yeah,
They
they've been
went
public.
public in 2000.
Yeah, but they've done extremely well the last few
Favorable
years.
rate for the,
Well, the government said we had to have more rating agencies, but S&P and Moody's dominate and they still dominate, and the government hasn't done anything. And this stock has done really well. It's a pretty amazing company. You talk about economic moats. They have the data to prove that a AAA means AAA. It's true they messed up on structured debt in 2008, but that was just on
that
structured
was
debt.
the 2008.
Yeah, they messed up, so did S&P, but they were making a fortune off of that, and they were kind of like, see no evil, hear no evil. But their corporate bond, their ratings have been very reliable. And that's why they haven't been replaced, because no one else has their history. S&P and Moody's is really it. There are just, I mentioned AM Best. AM Best,
Was it Fitch also?
well, Fitch is out there, but
They're not.
most people, Moody's and S&P, that's just the go-to. Yeah. If Fitch disagrees, they're going with S&P and Moody's. Yeah. I don't think Fitch ever visited USA. We only saw S&P and Moody's. AM Best only does insurance companies. That's all they know. Their ratings are not as highly respected. They're not used for the bond market. Their ratings are for customers, you know, for salespeople. So we get an A+ rating from AM Best. It's really not credit. The credit market doesn't look at them. Fitch is out there, Duff and Phelps. I think they may have merged. Weiss has really lost credibility. He essentially rated every firm really low. It's like, give us a break. There's no good companies out there, so he kind of lost credibility. So liquidity, asset liability management, asset quality. They want to know how much you have in junk bonds, what's your concentration in any particular name. Your market share, they want to see if you're getting better over time, getting worse. They worry about a firm that's going out of business. Lapse rates are extremely important. You hear that with Netflix, but it's extremely important for life insurance companies because life insurance is very expensive to sell. You have to underwrite it. You have to do blood tests and medical exams. And if the person cancels the policy 1 year later, you've lost a lot of money. So they need those lapse rates to be very low. They're worried about pyramiding of capital. So you may have a lot of net worth, but if you have a major subsidiary that really needs that net worth too, they don't want you double counting that. So if you got $1 billion in a subsidiary, well, that $1 billion is to protect the subsidiary. We're not going to count that in your net worth. They look at quality of management. They do that by interviewing management. There was a few times we had to kind of cool our CEO down before he walked into the meeting because he was so mad at them. It's like, no, calm down, settle down. They ask tough questions. It's really these young people, to me, people 28, 29, coming in, these CEOs that are, 55, 60 years old, and they're like, how can you ask me questions like that? They get pretty defensive, but they're like, I'm just doing my job. They're going to ask tough questions. They're wondering about underwriting practices. This was a big deal for USAA when they opened up to the enlisted market. What they discovered was the enlisted market doesn't die very fast, but they're horrible drivers. And USA assumed the enlisted market would drive as well as the officer market, and they'd be as healthy as the officer market. They were half right. So life insurance companies like, we love the enlisted market. They exercise, they run, they don't smoke. Well, they may smoke and drink, but they offset that with a lot of exercise. But on the property and casualty side, they were horrible drivers, and USA assumed they'd be good drivers. And USA's assumption was, if you have a DWI in the military, what happens? You're done for, right? You're out of the military. So the military somewhat underwrites you, or at least that's the argument they made at USA. So military somewhat underwrites you. If you have a lot of tickets and those kind of things, you get in trouble. But that didn't work. The enlisted market were not good drivers. So that's the question they asked. And, you know, Raisey is really concerned. You're going to open up to this massive new market and you don't have any data. And USA's actuaries are, yeah, right. It's pretty scary. But USA's managed like, no, they're really good people. They'll be just as good. But the life side said, we want them. They're great risk. And then the growth in the business, they're worried about too much and too little. Too little growth is bad because your business is just declining. Too much growth, you grow too fast. Maybe you're offering prices that are just not correct actuarially. You worry about that. But if you were an analyst at Standard & Poor's and Moody's, you'd be making really good money. You do it for 2 years, and then you can really work anywhere you want to. That's going to really make your resume look great. You work in New York mainly. Not that I'm encouraging y'all to do that, but jobs, rules, I don't know if they give pay scales. They show how much the pay is. Look how happy she is. It's a great job. So, you know, you could try it and see what they have. Early careers, that's kind of nice to know if you're coming in by now. AI. Analytics and model. Man, there's a job. Look at this, London. Boy, that's a job of finance. When are you finance major manage? Well, y'all are all graduating, right? When are you finance majors? Well, even actually, I bet they would hire actuaries for analytics and modeling intern. And you get to go to London. You have to learn a new language, but you know, you could at least work the asset management, AI summer. Actuaries, I can do some AI stuff, can't you? I've got some good Python. Community impact intern, I don't know what that means. Credit analyst intern. Get to go to Argentina. If you got some Spanish, that could work. So yeah, they've got some really good jobs here, good internships, and then all over the place. There you go, Costa Rica. You know, Spanish, that'd be pretty cool. So yeah. Great firms, S&P and Moody's, both great firms, high reputations. They did mess up in 08, no question, but very highly respected. And they do a lot of other stuff besides just credit ratings. They have quite a bit. I love Standard & Poor's website. It's really good.
Moody's estimated analyst jobs are 86 to 103,000.
Yeah, so if you start there, 80 to 100 is not great for New York. But 2 years of that on your resume will really unlock, especially if you get your CFA while you're there. You can essentially go anywhere you want, and it will jump really fast after that. So yeah, I mean, I paid my dues for 7 years, and that helped me at USA. So that was 7 days a week. Not all 7 years, but most of the 7 years I was working 7 days a week, and I was doing my master's and my CFA exam at the same time. I didn't see anybody. I mean, I was like, that was my entire life, but it paid off handsomely. I don't think you have to give up 7 years to do that, but if you really want to get those great jobs, you're probably going to have to spend 2 years where you don't see anybody. Your family, you might Zoom with them at Thanksgiving and Christmas, but I mean, it's pretty rough. I mean, they're long hours, but 2 years and it's on your resume, and then you go back to a normal job. All right. And if you do great in this job, in this class, apply to one of those jobs, put me down as a reference. You know, if they call me, they'll hire you. Trust me. I am very convincing with good, strong students. I'm really good. I know exactly what they're looking for. I know the words to say. And I had one guy who's like, I got to hang up because I'm worried he's going to take another job. Like, yeah, I told you, you need to hire this guy. So yeah, I'm really good. All right, regulation sounds boring, but it's actually really quite critical for this industry. You need to know who's regulating, why they're regulating, what do they regulate, and how do they do it. The SEC does regulate variable products, but for the most part, states regulate insurance companies. The US Constitution says that shouldn't be the case. The US Constitution says the federal government regulates interstate commerce. So it says any insurance companies that in more than one state should be regulated by the federal government. It's really clear in our Constitution. And yet the states regulate insurance. In Section 8, Congress regulates commerce among the states. So that word commerce is really important. Is insurance commerce? It seems obvious to me insurance is commerce. If banking is commerce, insurance is commerce. It's really obvious. But we had a test of that in 1869, Paul versus Virginia. Paul was from New York, and he wanted to sell insurance, probably property and casualty insurance in Virginia. Virginia says, fine, but we're going to license you. You have to be licensed to sell in our state. And Paul says, forget that. The US government says you can't regulate me. This is interstate commerce. And the Constitution says that because if Paul's coming from New York, Virginia's going to say, well, you're from New York, you're going to have to pay us $1,000. But if you're in Virginia, you only have to pay $100. So they're going to discriminate against non-Virginia residents. And so Paul says, hey, forget it. I'm not going to do that. Insurance, and the Supreme Court says insurance is not commerce. An obvious wrong answer, but anything going on in 1869? The Civil War ended in 1865, so we're in Reconstruction. Anything going on with the Supreme Court? Is states' rights a big controversial issue in 1869? So you got a Supreme Court that's very pro-states. You've got federal government that's trying to figure out what federalism means. Abraham Lincoln's not around, unfortunately, anymore. So it's a very, very touchy area. And essentially the Supreme Court just said, we're going to give it to the states. So it was this battle. The Supreme Court was pretty heavily loaded pro-state. And so that was the decision they made. That created a huge problem because now insurance companies thought they're going to have one regulator. Instead, they have a regulator times how many more states there are. And so insurance companies come and they say, you know what? How are we possibly going to compete? We gotta deal with all these regulators. So in 1871, the regulators all got together, and this organization still exists. Their website's a really good website, the National Association of Insurance Commissioners. I worked really closely with them for several years. It is all the regulators, and they said, as much as we can, we'll coordinate with each other so we don't have all these rules. The statutory accounting is one of the things they tried to coordinate, and they got it somewhat close. They also have certain laws that they develop, and then they try to get all the states to adopt them. They're called model laws. Risk-based capital that we're talking about is probably their most successful model law. Their worst is probably their investment law they try to write. This is one I got involved with. They wrote a new investment law, and they had me run it through SNL, and like 70% of the companies failed. I was telling them, yeah, you're going to pass a law where you're going to have to shut down 70% of the companies. I don't think you're going to do that. One of the regulators says, we don't care what you say, we're going to do it. But 2 days later, it was shut down. So sometimes they get it really, really, really bad, and sometimes they get it really, really good. Kind of just depends. There are a lot of laws related to market conduct. So remember that if you think your insurance company has mistreated you, you have a lot of protection in the law. The one thing I always do if a company is doing something bad is write a letter to the president of the company. They have to do something very special. Y'all remember when I talked about Danya, I wrote a letter to the president of the company, and they have to treat those specially. I did that with Wells Fargo. One guy finally quit after my letters. He was so fed up with his company because they kept messing up so badly. So, yeah, I mean, write up and address it, you have to find the address, but address it to the president of the company and you'll get special treatment. So that went on for several years, 1871 until 1944. And Southeastern Underwriters was being challenged by the US government for antitrust. And Southeastern Underwriters said, we don't care, we're not regulated by the federal government, we're regulated by the states, we don't care about antitrust. And you notice here, it's not versus a state, it's versus the federal government. And the Supreme Court said insurance is commerce. I was mentoring a kid in high school, and his teacher said it's extremely rare for the Supreme Court to override a previous decision. And so I said, well, yeah, you guess what? I got one for you that I bet no other student in this class is going to talk about. And so he wrote about this one. This teacher was like, what are you talking about? But yeah, this is a time where the Supreme Court came in, completely reversed previous decision. Now we got a huge problem. We've got all these insurance companies out there without a regulator. The states can't regulate, the federal government's not set up. And so in 1945, and you'll hear this talked about still today, you should know this law. If you're going into an interview, look this up on Wikipedia. In 1945, they passed the McCarran-Ferguson Act. And what it says is the federal government regulates insurance companies, but they can outsource that and they're going to hire the states to do it for them. And that's the way the law was set up. It's still in place today. It has been challenged several times. President Obama, when he passed the Affordable Care Act, in one of his speeches, he says, we got to get rid of McCarran-Ferguson. He wanted the federal government had more power over insurance companies. So that was when I was at the gym on the treadmill, I remember. I said, hey, President Obama just mentioned McCarran-Ferguson. So it's an important law. It's still in place, hasn't been taken away. USAA was actually one of very few companies asking for it in the McCarran-Ferguson so that they could have a federal charter. They were not supported in that. So today it's still in place. The challenges have been frequent. When I was at USAA, there was one point where we were sure it's going to be overturned. They had the votes in Congress. We had our lobbyists working on it. At that time, it was before this CEO. We were opposed to it at that point. And we thought we're done for it. It's going to be overturned. We didn't know what that meant. And then they just lost interest and the bill never got voted on. It just went away. So sometimes that happens in Congress. So why are they regulating? Because most of the debt, most of the finance provided to banks and insurance companies comes from their customers, not from the debt markets. The debt markets can take care of themselves. They're sophisticated investors. If they mess up, that's their problem. But policyholders, depositors, they're not good at taking care of themselves. So essentially, the reason we have regulation, so much regulation for insurance and banking, is the regulators essentially step in to protect those policyholders and act like bondholders. They sit there and look at the risks the company is doing. So I won't go through all of that, but that's the argument behind it. What did they regulate? Initially, it's solvency to make sure the company doesn't go out of business. During Teddy Roosevelt's years, we saw a lot of regulation come on the books during Roosevelt's years. And a lot of it was insurance companies for market conduct. Do you treat your customers correctly? Some of the things we talked about, churning and twisting, we saw that with Donya. Remember where he got her to change policy so he get another commission. Twisting is just lying. So those rules have come in and they have been fairly extensive in the insurance industry, and they're still coming into play. Most of this is rearview mirror kind of stuff, where something hits the news, it's bad headlines, and regulators react and create some new law to adjust for it. Pricing is a big issue, but on the property and casualty side. Pricing is not an issue on the life insurance side. I don't know why, because life insurance pricing is horrible. Make sure you shop around for rates for life insurance, but most people buy life insurance from whoever's selling it to them. You have those commission agents and they buy from them, but you should, anyone tries to sell you life insurance, you should tell them, I can't do that without comparing to other policies. I'm going to go look at, my list, look at USAA, because USAA always wants me in the top 25%. That helps you a lot. Look at MetLife, look at New York Life, Look at State Farm. There's several really good companies out there. And when does it really help you? Well, if it's a universal life policy, you have no hope anyway, right? There's no way to compare that. But if it's a level term, 10-year level term, just the cheapest rate, real easy. If it's whole life, the cheapest rate, really straightforward. If it's an immediate annuity, it's your highest monthly income. So there are policies. So on those policies, if you don't shop around at least 5 different companies, you're making a huge mistake. We talk about Primerica, their policies could be 100, 200% higher than other competitors. You're just really wasting. Your monthly premium could be $50 and they're going to charge you $150. You got to shop around. But on the P&C side, where there is a lot more competition, there's a lot of rate regulation. Now, I'm not saying you shouldn't price. When's the last time you looked at your auto insurance rates? Have y'all shopped those around? How many of y'all are using the same policy your mom and dad are using? So shop around. Who should you shop around? USAA, Allstate, State Farm. It's pretty straightforward. Geico is really competitive. Progressive is really competitive. It's a little tough. Esurance is out there. You can use Esurance. It's a little tough because it's hard to compare exactly apples to apples because there's so many bells and whistles in an auto policy. But shop around. But the regulators do really regulate auto insurance quite extensively. They don't do it with life insurance. My P&C class we talked about, they want them to be adequate, not too low, not excessive, not too high, and not discriminatory. But they do discriminate. They discriminate on gender. They charge men more for auto insurance. They charge women more for health insurance. They discriminate on age. I mean, what other industry that can discriminate on gender and age? This is the one big advantage they have, but they're allowed to do that. They can discriminate on neighborhood. That gets really close to to things they can't discriminate on, the neighborhood. Credit score, well, we talked about that in my property and casualty class. Illegal discrimination is the obvious things you can't, including random. You can't just charge people more money because you don't like them. You have to have actual data to prove it. But regulators get involved in that. It's a much bigger issue on the property and casualty side, though. It's not as big of an issue on the life side. I won't go into the example there. How they do it, it's the regulators, the executive branch. They do examinations. They have racial analysis. I dealt with examiners. I wouldn't recommend this as a job, but I know some people who work in that industry. I think it's really boring, but it's a pretty easy life. You walk into an insurance company, you're there for 3 weeks, 4 weeks. You have your little place. This seemed like a pretty easy job. I had some pretty good run-ins with examiners during my life. They didn't like me much, but that's all right. All right. I'm not going to address legal issues with life insurance companies other than you don't take business law anymore. There's one basic thing you should know in business law, and that's the 5 components for a valid contract. Let's see if y'all know them. What do you have to have for a valid contract? You should know this. I'm surprised y'all don't take business law. That's really disappointing. If you're going to work in the insurance industry, you better learn business law. If you're a finance major, you should have business law. I mean, y'all know the UCC. Y'all know agency theory. Agency theory is really important in insurance. What's more dangerous, a credit card payment, a check payment, an ACH payment? Which law protects you more? You should know these kind of things. Pretty important. But what's a valid contract means what 5 things? Your guesses? I mean, if you're looking at notes, you can read ahead. But we're not a witness. Huh? A witness. A witness. Somebody to witness you, right? Not necessarily a witness. No, that's a good guess. Huh?
Like a signature or agreement?
Agreement. So you have to have a meeting of the minds. Both sides have to have a meeting of minds. A signature, but a contract doesn't have to have a signature. All right, meeting of minds. What else? Can you
time frame?
Huh?
A time frame?
No, it doesn't have to be a time frame. I'm not talking about insurance contracts. Aaron?
Signature?
Not signatures. That's the meeting of the minds. So you can have a verbal contract without any signature, and courts will uphold it. But what will Judge Judy say? You should have had it in writing, right? Because verbal, now it's text. What did you say in the text? All right, so All right, so yeah, you're hitting on it. So you have to have offer and acceptance. There has to be an agreement. All right, offer and acceptance. You can't get into a contract with someone who has no idea what you're doing. Now this one's important for insurance, because of agency law. When you have an agent in your house and you have an insurance contract, what kind of agent are they? So when you take agency theory, when I took business law, we had one entire chapter just on agency. Can they bind the company? If they're a broker, they can't. If they're an independent agent, they can't. If they're an agent like State Farm, they can't. And the State Farm agent can bind the company, but other agents can't. The company still has to accept you. So that comes to be important. Consideration. There has to be consideration. So if you have a 2025 Jaguar and your neighbor has a contract with you to sell that to them for 2 cents, you have a pretty strong case in court that was a joke. You were joking. Your neighbor says, "Oh no, he meant it. He signed," and you're just joking around. They're gonna say 2 cents for a brand new Jaguar. Yeah, the judge is gonna say obviously there wasn't adequate consideration. But in insurance, what if you buy a 10-year level term policy and you pay your premiums for 10 years? What did the insurance company give you? Didn't give you anything. Can you then go to court after 10 years and say, "Hey, I paid my consideration, they didn't give me anything"? No, because the court's going to say a promise to do something is consideration. A promise to pay you if you die is consideration. You don't have to die to get consideration. You have to have legal capacity. That's kind of what you're talking about, Nathan. I think both parties have to be capable. So minors is a good example. You can't have a contract with a minor. There's a famous what's that movie? Liar, Liar. What's that? I've seen that movie. What's that guy's Jim Carrey? The liar one that he got the lady out of the prenuptial because she signed it. She lied on her driver's license. She was really 17 when she signed. Y'all haven't seen that movie? It's a really funny movie. Y'all know who Jim Carrey is? It's one of his few really good movies. So it's pretty good. So, yeah, legal capacity. So he could prove she was 17 when she signed the prenup. Says you're out of it. It's funny because in this movie he has to tell the truth. And it's quite hilarious because he's a lawyer. But pretty hilarious. But anyway, that's with minors. There is an exception for minors for necessities. You can't have a contract with a minor. So you have some kid that is living on his own, doesn't have parents. For necessities, you can do that, but I doubt any company is going to do that. They can't be intoxicated, mentally incapacitated, those kind of things. So those are kind of ways you can get out of a contract because the person just isn't there. This next one, I mean, you might ask if insurance is a necessity. I guess some insurance companies might argue health insurance is a necessity. Auto insurance is a necessity. The kid needs to get to work. I doubt insurance companies are going to do contracts with a minor without some adult signing for them. And then the next one is extremely important as well. It can't be contrary to public interest. So if you sign a contract with your neighbor to deliver, I know nothing about drugs, but say 10 pounds of cocaine, and he doesn't deliver it, you can take him to court, and the court's just going to throw it out. It's like, we can't do that. Some people question insurance because you buy insurance on someone's life. Are you encouraging that person to commit murder? And the insurance company says, no, we require insurable interest. We want to make sure the person wants the person alive. So, and then what's the last one? Y'all been hinting at this one all along. It has to be in the correct legal form. Some contracts must be in writing. Insurance must be in writing. So those of you who said a signature for insurance, that is correct. You do have to have an insurance, a signature. It has to be in writing, but not all contracts. If you watch I don't like Judge Judy at all, but I do like Yo Yan, the other one. She's really, really good. I like watching her because I could test my business law skills. But yeah, you can do a verbal contract, but insurance you can't. You have to have it in writing. So yeah, take business law. Can you take it as an elective? It's a really valuable class. All right. So what are we doing on Thursday? Everybody knows. We're going to be working on exam stuff. You have videos already, so come Thursday night and get ready. All right, that's it. So what are the formulas? So level term, it's pretty obvious. You're going to have some D's, times a face divided by 1 plus a rate to the first plus a D times a face divided by 1 plus a rate to the second, etc. That's what the numerator looks like. You're going to see that over and over again because it's the exact same formula for ordinary whole life. And what do you divide by? The division looks exactly the same. It's life. I mean, the number of people alive, but enough people alive divided by 1 plus the rate to the first plus life divided by, etc. So you'll see this formula a lot. If it's 3-year level term, you should have 3 Ds. And you do it to the rate to the first, the second to the third. You should have 3 L's. The first L you don't discount. The second L to the first, the third L. So use that formula over and again. Ordinary life is exactly the same, except you don't stop until when? So D99 and L99. You have to go all the way out to the very, very end of the table. So should be really straightforward. You just see it over and over again. We'll practice some on that tonight, but the word ordinary tells you that you'll have just as many L's as you have D's. So whatever you do with the D's, you do that with L. If it's limit pay, then I'll have to tell you how many L's there are. I'll tell you if there's 2 L's or 3 L's or whatever. But if it says ordinary life, it's just like level term. Level term, if it's 3-year level term, you're going to have 3 D's in a numerator, 3 L's in a denominator. If it's ordinary at age 96, you're going to have D96, D97. Sorry. D97, D98, D99. You're going to have L96, L97, L98, L99. Real straightforward. Anytime it's ordinary, you just go all the way out to the very end until you hit 99. But the formula looks exactly the same. It's just which D's do you use. So nothing new there. The endowment is the tricky one. But here it looks exactly like the level term, except, and remember that one exception. You take the level term and you do what? So you have D50, D51, D52. What do you have to do in the numerator? D50, D51, D52. And what does the endowment do? If you're alive, you also get the money. All right. So the only difference between the endowment and level term is that you get the money if you die, and at the end, if you're still alive, you still get the money. You take this raised to the first, this raised to the second, this raised to the third, and this one raised to the what? Also to the third. All right, that's the one tricky thing. Why? Because we pay death benefits at the end of the year, we pay life benefits at the beginning of the year. So these two are actually paid at the exact same time. All right, so that's the only tricky thing with the endowment. It's the most mathematical one because I do make you actually calculate this one. So when you have to calculate and you have to do the table, we'll walk through one of those. You have all of this in your notes. We've done this in class. And this last one, it's just a matter of if it's a D, put the D in there. If there's an L, put an L in it. Who's paying the premiums? That goes in the numerators. And then you just got to figure out the ends. Remember on the ends, if it's a D, the N will equal the age minus issue age plus 1. If it's an L, the N equals age minus issue age. Why? Because anything that's paid to L's is paid at the beginning of the year. Anything paid to D is paid at the end of the year. So that's the only tricky thing with this creative product. Some students leave this one blank, and my word, you just did problems very similar to it up here. So just put as much down as you can. I do give partial credit. The joint life, we'll just have to work one because that one's not a little tricky. I don't know if I have time for the ALM, but we did the ALM the last couple of classes. Hopefully that's fresh in your mind. That one's the most straightforward one of them. We'll see if we have time, but that's the exam. Any questions on the overall? It's closed book. You don't need any notes. All right, so let me show you sample exam questions. So let's try this one. Ah, come on, Bill Gates. It's a 4-year level term. So how many D's are there going to be in the numerator? Not a trick question. Be 4. How many L's in the numerator? 4. All right. So what's your first D going to be? D40. And you don't have to go to the table. You just type D40. How much is the face value here? 5,000. Divide plus 1 plus the rate. What's the rate here? 4%. Raise it to the first. Then you go to D41 times 5,000 divided by 1 plus the rate, raised to the second. No, you don't. You do have some sample problems out there. I put some extra sample problems out there on Canvas. D42 times 5,000 plus 0.04 raised to the 3 plus D43 times 5,000. So there's your numerator. You can take all of that. Yeah, the key doesn't work, but okay. And divide that by, and the numerator looks really similar. L40, except for you don't multiply by the face. Just L40, L41 divided by 1 plus the rate plus, excuse me, L42. Whoa. So it's a really, really straightforward problem. You see level 4-year level term, 4 Ds, 4 Ls. All you got to remember is that the L's are one off. So the first D you divide it by 1.04 to the first L you don't do that because you're paying the premium at the beginning of the year. The second one you do to the first. The second D you do to the second. The third L you do to the second. The third D you go to the third. The fourth L, it's raised to the third. The fourth D, you raise to the fourth. All right. So if you got that, it's just over and over again. What if I change this to ordinary life? Issued at age 96. What would we change here? It's the exact same formula, isn't it? All we have to do is change what? 99. Yeah, 96. Everything else is exactly the same. I messed up somewhere. 97 here. A good way to think about this is an ordinary life policy issued at age 96 is like a 4-year level term policy issued at 96. It's the same thing. So the formulas are exactly the same. There's no reason not to give full credit on those two formulas because they really are pretty strong. Most students do get without any trouble. And you notice I've given you 8 minutes to do something that probably should take you a minute, minute and a half. So you got plenty of time on the more complicated calculations to kind of have extra time. I took out all those those symbol questions that students did so horribly on in past exams and just saved you that. All right, any questions on ordinary life or level term? That making sense? So there's ordinary whole life policy. Looks exactly the same. I won't do it again, but it looks exactly the same. All right, here's the tough problem. I don't know if we will go all the way through this one, but so this is an endowment. So when you see an endowment, think about an endowment. It looks just like a level term. All right, the formula we just did looks exactly like that. We just can make one extra payment. All right, so let's first do this. Pretend it's level term. All right, don't do this, but let's just, if it was level term, what would the formula be? Start with what? D40. What's the face? 500, not much of a policy, right? 1 plus, what's our rate? 4%. Raise to the first. D41 times 500 divided by 1 plus 0.04. Raise to the second plus D42 times 500 divided by 1 plus 0.04 raised to the third. And the denominator, I haven't finished the numerator yet. We'll get back to it. But then the denominator looks exactly the same as before. L40 plus L41 divided by 1 plus 0.04 plus L42 divided by 1 plus 0.04 raised to the second. So that looks exactly like the level term, right? So you shouldn't be, it's like, wow, this is a whole new problem. It really isn't. What's the only thing we add to this? Is people alive at age 43, they also get the $500. That's why it's an endowment. Endowment means you get paid if you live. Divided by 1 plus 0.4. And what do I raise this to? Anybody remember? To the third, right? Anytime you have an L, it's going to be 1 year shorter. But other than this, so just get this in your notes. Other than that one little spot there, the endowment is exactly like the level term. So learn the level term and the endowment, just know you got to throw that one extra piece there at the end. Make sure you know it goes D42, L43. These two groups happen at the exact same time. Because remember, you die at the very end of the year. The people who die at the very end of the year and the people alive the next day, that's essentially L42, really, but that's essentially happening at the exact same time. That's what we're using to raise to the third power. We're paying this at the end of the third year. We're paying this at the beginning of the fourth year, which is still raised to the third. Now, the question is on this one, you notice what it says, do solve, all right? So this is where it's 14 minutes, but it might take you 20 minutes. So this one's heavy calculations. You'll probably make a math error, but you can get practically, you probably could even get 100% credit if you just have a math error somewhere. So you don't have to sit there and spend all night on it. You can't, if you did it in Excel, you did it right because the very end of the calculation would give you a 0. But because you're using rounding numbers, you won't be able to get it all the way to 0. But let's take this and let's look at it using the mortality table. I need to put this mortality table out there with all of our problems on it. But let's work this problem. So D40, how do you get D40 out of the table? Is it pretty obvious? Which column is D? Column D is D, those dying. What is D40? Looks like 294 to me, right? Everybody see that? So D40. D40 is 294, then 318, then 343. We only need three of them, 94, 318, and 343. So there's our Ds. And then we need L43. L43, these L's are in the second column, in column B. L43 is 96,088. And then we need our premium payers, L40, L41, and L42. So L40, right there. You will have, yes, some students, I think they're joking or not, but they asked me, will the mortality table be on the exam? And I always think they're joking and they're not. But no, you don't have to memorize the mortality table for the exam, all right? Anybody worried about that? All right, some of y'all worry way too much. Could you imagine memorizing this table for an exam? That would be really useful to your career. So no, I'll give you the table. It's on the exam. You can see how it is on this exam. It's just the very last page. You get the table. It'll be a separate page. You can take it out of the exam and have it separate. All right, so we've got all the data, so we just have to calculate it. So it's a matter of getting the formula. I'd highly recommend you write the formula down first like that, then write it again with the numbers in it so that I can see you know the formula. I'll give you quite a bit of points if you can just show me that you know the formula for an endowment. So get this written down first and then plug in the data, 294, 318, 343. Oh, last one. 96,088, and then 97,043, 96,749. I did it again. I keep leaving out L9, 41, 96,749. I picked up the wrong number anyway. Let's see, 96,431. Hopefully I did that right. And now it's how good are you with a calculator? So you just got to start plugging numbers in there. Y'all try it and see if you can do it. Does that look correct so far? Any calculator is fine as long as you don't have formulas saved, but yeah, it can be a scientific calculator. I don't know if a graphing would help you much in this, but a scientific should help. Huh?
You can see a lot more on graph chat.
Yeah, that's fine. It doesn't matter to me as long as you don't have saved formulas. So there's the numerator and then the denominator, 97,043 plus 96,749 divided by 1.04 plus 96,431 divided by 1.04 raised to the second. Bill Gates thinks I did something wrong. I know I didn't, but we'll see. It's probably a parentheses issue. I don't. Which one? Yeah. You can see why Matt there is, huh? This one here. But what's the issue there? I don't. What is Bill Gates saying? There's a problem not trying to type B type equals 1. Yeah, I don't know what Bill Gates is telling me. Yeah, I don't see the issue in there. Yeah, I shouldn't use a comma. Yeah, if I do that, yeah, that's that's probably it. Ah, good catch. All right. Here we go. Now, you don't need to go out.
Yeah, um, for B42, you use, parent two, instead of parent three.
Well, on the bottom, it's 0. Down here. Oh, I did 3 there. Ah, good catch. No, wait. Well, y'all tell me. What should it be? I think that one's 3. This one should be 3, right? All right, good catch. I should pay Nathan for catching all my errors. He gets about 90% of them. All right, does that look right? All right. 154.54. It's actually 154.018. So this one will probably come pretty close. So it won't be off by a bunch. I do try to get the answers so it's, not 154.54536.7, something that's going to really get you off at the end. So hopefully it'll be pretty close. All right, so that gives you a lot of points. Then what do you have to do next? All right, so there's a good chance that's going to be the wrong answer. But if you write it down and you just have some math error, it doesn't cost you that much. I'm really looking to see if you understand the process because it's a lot of calculations. So then the next thing you're going to do is the schedule. So what you're doing is time 0, time 1, time 2, time 3. So what happened to each one of these? Well, time 1, you collect the premium and you invest the premium. All right. That also happens at time 1. It also happens at time 2. Doesn't happen at time 3 because you only collect 3 premiums at time 0, time 1, and time 2. So for the first 3 times you collect the premium and you invest the premium. At time 1, you're going to pay claims. At time 2, you're going to pay claims. And at time 3, you're going to pay claims. All right. So the only thing I need to add to that is at the beginning of time 1, we're going to have the portfolio roll forward. That's going to be the same thing at time 2. And then at time 3, you have the portfolio roll forward. And you're hoping the net is going to be 0. It won't be, but it should be. It won't be because of rounding, but that's what you average. So, all right, someone tell me that. Time 1, what do you do? Collect the premium and invest, all right? Time 2 comes across, you have 4 things to do that. The first thing is portfolio matures, very good. Then you collect the premium, invest. Actually, you should probably switch those last 2, but let me do that. Good catch. Because you're probably going to pay the claims and then invest the portfolio, right? Because you're going to invest the net. So we should switch those last 2, sorry. All right. Time 1, collect the premium, invest it. Time 2, portfolio rolls forward, collect the premium, pay your claim, reinvest. Do that at time 1, do that at time 2, time 3. What's the one thing you get rid of at time 3? No more premium. All you're going to do is pay claims. All right. So they look almost identical. Time 0 doesn't have pay the claims. Time 3 doesn't have collect the premiums, but otherwise it's the same thing. Collect the premiums, invest, pay claims, or pay claims, collect the premium. All right. So at time 0, can collect the premium. So our premium is 154.54 times our L40s, 97,043. So 154.54 times 97,043. That's my premium. I would go out the pennies, but don't go out any further than pennies. And then you're going to invest that at 5% or 4%. What is it? 4%. We invest that at 4%. All right. you roll the portfolio forward, it's gonna be the prior net times 1 plus 4%. So here we have 14,997,025.22. Why is that our net? Because we didn't pay any claims. Times 1.04. We're going to collect the premium, so we're going to take 154.54 times our next group, 96,749. So we're going to collect the premium. We're going to pay claims to the D40s. Our D40s are $294. We're going to pay them each $500. So we'll pay 147. So our investor premium, how much do we invest? You take portfolio plus the premium minus the claim. You're going to invest 15,596,906.23 plus 14,951,590.46 minus 147,000. Looks like we have too much money, right? But remember, we're going to pay a whole lot of money out at the end because we have all those livers we're going to pay out. So then you're going to take the prior net times 1 plus 0.04. So 30,404,496.69 times 1.04. Collective premiums, 96,431. So 154.54 times that. Never have to handle premiums anymore, pay the claims. So here we're going to pay the D41s, 318. And so our net is the port plus the frame minus the claim. All right, hopefully I'm getting the right number. We'll see at the end. It's close. And so here we take prior net times 1 plus 0.04. So 180, 486, 123.3 times 1.04. No premium this time. We're going to pay our claims. Our claims are going to be paid to D42, that's 343. But we're also going to pay the L43s, 96. So D42 and L43, 96,088. They're all going to get $500. All right, but questions on the problem? You see the problem is really not a new problem. You just got to add one little thing to the level term and really just becomes a matter of calculating, which is a bear, I realize. That's why I only have you calculate once on these type of problems, because it gets to be pretty serious. That still bugs me why it's off, but someone will figure it out. All right, so tell me again, time one. I mean, time zero, excuse me, you're right, Rocio, but time zero. Like premium, invest, time one. Collect premium. Claim. That's the net. All right. Time two looks exactly like what? Time one. then time 3. All right, so y'all got it now, right? It's not as complicated as you may think. Why am I making you do all of that? If you understand that, you really understand how life insurance works. Understanding that order, that how that goes in shows you exactly how it works. It'd be nicer if the numbers actually match, but I can't get it to match. 332. It's 333. All right, y'all want a drum roll? You think this will do it? Look at that. All right, so there it was. I had one math error right there. Just shows you how easy it is to do math errors in here. So I was off by 1. What's amazing, I was off by 1 twice. 96,431. I even had it typed right here, and I don't know how that this makes no sense to me at all. All right. Anyway, you have this problem out there. Here you can see unrounded, it was off by $57. I mean, rounded, it was off $57. Unrounded, you get it to the pennies. So you'll be off by a little bit. It could be off by $300 or $400, but I really try hard so that it's not off by that much. All right, so it makes me feel better. All right, good, good. All right, so here I named this one after a UTSA player. So the Sincere Life Company developed a new life product. Have we done this one before? This one's out there on Canvas. It is issued to people aged 25. You pay a premium at the beginning of age 25, 26, and the same premium again. So let's just, rather, some students look at this and they just go catatonic, and you don't want to do that. So when they pay premiums, remember when you pay a premium, you put that into the denominator. So they're going to pay a premium age 25 and 26. All right. It's issued age 25. So if you think about the premium, this is the denominator. You're going to be dividing by L25 plus L26 divided by 1.05. That's your discount rate. Those are the first 2 premium payments, all right? So get the premium. The premium payments to me are the easiest. 25, 26. The same premium again at age 40 and 41. So now we're going to have what in the denominator? L40 and L41. So now the only question is, what do we raise it to? What did I say about L's? The issue age is 25. This is 40. So is it going to be 15 or 16? 15, right? 40 minus 25. And 41, you're going to divide by 1.04 raised to the 16. All right. So if it's a premium payment, anything with an L, you just subtract. Age 40 minus age 25. Age 41 minus 25, 15, and 16. All right. That's real straightforward. So that takes care of those 2 premium payments. Then it pays. So no more premium payments. So just like that, we already have the denominator. That was easy, right? Premiums are so easy. Everybody's get premiums right. You don't have to worry about the face. All you got to do is divide by 1 plus the rate. All right. So what about the numerator? Remember, in the numerator, if it's D's, what is your N going to be? The time that they die minus issue age plus 1. All right, that's kind of obvious, right? Because if you use D25, you're going to divide by 1.04 to the first. Because 25 minus 25 is 0, plus 1 is 1, all right? So here, let's look at pays. There's no payments after these first 4 premium payments. It then pays a lump sum to anyone alive. So that's not a D, is it? So numerator is going to start with an L. Which L is it? At the beginning of age 85. times how much? 3 million divided by 1.04 raised to the what? Here, they're alive. 85, 25, what do you get? It's going to be 60. Why isn't it 61? Because it's an L, it's not a D. Okay, everybody getting that? So 85 minus 25 is 60, and because it's an L, it stays 60. If it were a death benefit, we would make it 61. So pays a lump sum, anyone alive? A lump sum of 5 million, anyone alive at age 90? How much? 5 million? Don't tell me, but write it down. What's your N for this one? Don't say it out loud. Everybody's got it? All right, I'll say it together as a class. What is it? 65. All right. I heard Nathan's voice, but the rest of y'all are thinking that, right? All right. He's an X-ray. He's supposed to know it, but the rest of y'all, you're going to have to know it too. All right, there's age 90. And a lump sum of 10 million for those alive at age 9. These are all livers. So there's no D's here at all. Raised to the what here? 95, 70, right? There's our numerator. We now have the entire equation, just like that. Pretty easy problem, actually, all right? What if we instead said it pays out the people dying? What would you do then? E85 to the what? 61. B90 to the what? 66. E95 to 71. What if it said anybody alive at 85? Anyone alive at 90? But then anyone who dies at 95. So you can mix them and match them any way. You just know if it's an L, subtract. If it's a D, subtract and add 1. All right, makes the problem really, really, really simple. This one you do actually calculate. Generally, it's the same thing with matured endowment or the endowment. The majority of class don't get the right premium. So I've had some classes, I mean, the first time I did these problems, I think I told you one finance major got the exact answer to the penny. Since then, it's maybe 10, 20% get the exact answer. So you don't need to spend hours. You can get almost, and it's even possible to get full credit if you write it all out. But I would make sure to, on all these problems with calculations, write out the problem using symbols first. So I see you know how the problem works, and then stick the numbers in. Because all you do is you calculate, and give me a number, and you can see show all work. If you get a wrong answer, you don't show any work, I can't give you anything. Even if it's kind of in the ballpark, you know, the answer is 154, you get 182, I can't give you even a single point without you showing me the work. You get quite a few points by just writing this out. And if you get one of the ends off, you would still get some good partial credit. So write it out. But y'all see how straightforward it is? Put your premiums in the numerator, put your L's or D's in the denominator. I mean, put your premiums in the denominator, put your L's and D's in the numerator, figure out the ends, and you got the problem. What I love about this problem is it really shows that it's not as complicated as it seemed when we started. It really is just read, see what's a cash outflow, what's a cash inflow, discounted to the day, depending on whether it's paid at the beginning of the year or end of the year. Pretty straightforward. Here, the premium is 16,767.21. So you might practice on that one just to see if you have it. All right, everybody's good on that. All right, let's do a joint life because this one I'm a little bit worried about. This is one a lot of students miss just because they run out of steam studying. So far, everything I'm showing you is real similar problems. We just did 4 problems and they all looked almost identical, which is minor exceptions. So here on the joint life, it looks different.
because we're going to use the probabilities slightly differently. So in a joint life pays if one or both die. Does not pay if what? If both live. All right. So what you want to do is step one, calculate probability both live. That's going to be L divided by L times L divided by L. All right. In this case, the younger spouse is 92. So you're going to divide 93 over 92. What's that probability? That's the probability someone aged 92 will live another year, right? Because you can take people alive at 93 divided by the people alive at 92. So you got the 92. You got someone tell me the second one. What do we put here? L 95 and 94, all right? So you start with that. That's going to equal 495. So 94 is 2. 93 is 2. 963. 92 is 3. 968. Times, and 95 is 1518. 94 is 2156. Hopefully I got all of those in there. All right, that's the probability both of them live. The answer there is 0.4742. Sounds sad. There's a 50% chance, there's more than a 50% chance one of these people is going to die, but they're in their 90s. So give them a break. You know, when you get up in your 90s, it's getting less likely. All right, any questions on that? You start with that. Now, if you remember the previous problems, we did death benefits divided by premium payers. We essentially have already taken into consideration the premium payers by doing this math here. So all you have to do you calculate the premium, and this one you're just going to memorize. It's going to be the probability, 1 minus the probability both live, because in that case, if they both live, nothing gets paid, times the face divided by 1 plus the rate. So you say, well, there's a premium payers. It's right there. We already got it divided. So in this case, we have 1 minus 0.4742 times 10,000 divided by 1.04. That's going to equal 45.9262. All right, that's half the problem. So calculate the premium. So there it is. There's the premium. All right. So the question is this. This is the part, you know, if you had to leave something out on the study, this wouldn't kill you on the exam. I'd recommend you go and do it, but you want to compare the two term policies. So two term policies, this looks like what we've done before. Here you're going to have D92 times 10,000 divided by L92. Divided by 1.04 divided by L92. That's the old formula we've been doing before. So you take the death benefit and divide it by 1 plus the rate and divide it by the livers. Since they're paying only one premium, you don't have to adjust the livers because they're paid a day, so there's no divide by anything. The other premium is going to be D94 times 10,000 divided by 1.04 divided by L94. So what are those premiums? I'm just putting this up here twice. 24.35 and 28.45. The total is going to be 2435.35 plus 2845.37. That equals 5820.72. Versus how much did this one cost you? The difference is 5 to 80.72 minus 4559.62. Difference equals 720.66. So it saves them quite a bit of money. Now, to get full points, you got to show to me why does it save them so much money. Anybody know what's the difference in these two policies? Why is the joint life cheaper? Or maybe right away, where's the one situation where the two-term policies win? Both dies. So the probability both die is going to equal D92 divided by L92 times D94 divided by L94. That's 7.49%. You take 0.0749 times $10,000 divided by 1.04 and 10,000 times that, guess what you get? 720.66. All right. Now, if you just can't handle this problem, I have one problem that's a little tougher. This one's a little tougher to get through the whole thing. I usually have about 30% of the class will get this full credit on this one, but what you don't want to do is because you don't understand the entire problem, you just leave it blank. So put something down. So some of this stuff is pretty straightforward. This one takes a little more time and a little more practice. You could just do this problem over and over again. I may have told you that story that with one exam in my graduate work. I just took one problem and worked it over and over again because I figured that if I get stuck on the exam, I'll just work that problem and I'll just fill in the places there. And then the instructor on the exam gave that problem on the exam. So I knew the answer even before I even started. It's like, oh, I've done this like 50 times. So that's what I do. I just keep working the same problem over and over again until I can get it without any struggle, get the exact answer. And then if you can't remember the problem, you can just reconstruct that problem and say, oh yeah, I see what you do. So it's got several pieces in it. I love it as a problem because it does have you working with mortality table. The probability both live, probably both die. So what's your recommendation for younger people? Buy two term because saves almost nothing to do joint life. Why? Because probability both die is extremely low. All right, so that's part of your answer, right? Young people, just buy two term policies. Joint life, it's going to save you like 3 cents a year or something. It's not worth it. For older people, I mean, much older, joint life will save quite a bit more, but which you buy depends on your circumstances. I mean, it really comes down to, does it matter if you both die or not? If there's no big consequences if you both die or just one dies, and just buy the joint life and save $722. If your heirs are in a lot of trouble, if you both died, or like, my word, what are we gonna do now? We don't have anyone to take care of all this stuff, then yeah, buy the 2-term, pay the extra $720. And that, that 7% chance that you both die. Right? That's probably the most missed problem on the exam, but other than this really complicated problem, but I'm hoping y'all will do that. Any of y'all know Sincere? What do you think if I told him I'm using his name? Is he in an NFL now? Anybody know? Raiders? Is he actually playing? No. Wheaton was playing. He had like 10 points a few games ago, so we got some famous people out there. All right. Where's the I don't see the final problem. All right, so I've worked everything on the exam except for the ALM problem. And I think we've already worked this one in a previous class. So yeah, we actually worked this one in previous class. I don't know if I have another ALM. I think we worked this one in class. I don't know if we worked this one in class. Does this one look familiar? Here's another one. I don't think we did this one. All right, since we've just been doing these, if you don't need this one, you're free to leave as long as I have you for attendance. Otherwise, I'm going to work this one. Y'all want to see me work this one? They're like, well, I haven't seen it for like 2 days. So yeah, I know y'all are stressed. I'm stressed too, but for different reasons. I remember one final for business law. We were talking business law. It's like 3 hours before the exam. I'm going, I'm ready. And I go, wait, was this a cumulative final? And so then I'm panicking and going, it wasn't. So it wasn't a big deal, but oh man, I was panicking. It's like, oh man, that was like a nightmare. All right. Anybody remember step 1 on this one? Calculate the what? The capital requirements, right? Start with that. So you got the triple B bond, you got the high yield, you have C1 risk, you got C3 risk, and you got the total. So 4% and 20 are the same. You can see here they're using 150%. So 150% is going to take the 4% to 6 and the 20% to 30. The premium's 100,000. So here you take 0.04 times 1.5 times 100,000. That's going to equal 6,000. For the high yield, you can take 0.2 times 1.5 times 100K. That's going to equal 30,000. The C3 risk is the same for both. C3 risk has a 1% requirement, but again, the 150 applies. So you'll take 0.01 times 1.5 times 100K. It's going to equal 1,500. So these gives you 7,500. And this gives you 31,500. So get those cap requirements out of the way. Don't forget the 150 down here. These numbers will be the same on the exam because these are given by the state governments. So use that number, use that number, use that number. If you want to mark them as you use them, bring a highlighter. That way, if you have something that's not marked, you messed up. We used 100,000 right to apply it out. So we've used those numbers. Step 2, anybody remember step 2? Create the what? Income statement. So you got triple B, high yield. You have your revenue, your net revenue, which is the haircut. You have your credit, interest, your expenses, you have your net income, and your ROE. So those are the pieces you do. Your revenue, you take your $100,000 times 3%, so that's going to be $3,000. High yield, you're going to take your 100,000 times 670, so that's going to be 6,700. Your haircut, so we've used that. That. Your haircut is 0.1% and 2%, so 0.1% it's going to be 100. And 2% will be 2,000. Your interest crediting expense, the nice thing about those is it's the same for both. So 1.3 and 1.1. So we use those two numbers, 1,300 and 1,100. So those will be the same. And your net income, who knows? So 3,000, you just subtract everything, minus 100, minus 1,300, minus 1,100. 6,700 minus 2,000 minus 1,300 minus 1,100. So you got 500 and 2,300. And here you just divide it out, 500 divided by 7,500, 2,300 divided by 31,500. So 667 and 730. What's the one number we haven't used yet? The target ROE, 7%. Only the high yield hits. We've talked quite a bit in class. So you're not going to put 100% in high yield or even 90%. What's the most you might put in high yield? 10% is pretty high for regulators. And then you have that list in the notes. Remember that list? Try to get more interest income, but that's going to be taking more risk. Change the haircut, but haircut is what it is. Reduce your crediting interest, but that makes you less competitive. Reduce your expenses. You should be doing that anyway. Reduce your RBC requirement, but that may mean you get downgraded. Try to fix this 1% by changing the product that makes your customer upset. I forget if there's any others I had in there, but it's essentially following the income statement across. All right, so you have that problem out there. And you have the class videos as well that work through these. All right, any final questions? There's no ambiguity on the exam, right? You've essentially seen the entire exam, so you just gotta get some formulas down. So should you memorize these formulas? Absolutely not. You should just know them. All right, this is discounted cash flows, mortality tables. You should be able to do this. So, all right, we'll stop it there. I'll see y'all next Tuesday, right? At 5, whatever I put on the exam review.